Hi, you're listening to Mind Your Business with Karla Dennis, and I am Karla Dennis. All the years that I've been in business, I have to tell you, I've seen so many business owners lose their business, make critical mistakes in their business because of lack of knowledge. I want to provide you with great tools and content so that you don't make these same critical mistakes in your business. All right, we're going to jump right into Karla's mailbag, part of my favorite part of the show, where my followers are sending in questions for me to answer. Our first question has come in, and it's regarding being a 1099 consultant. And it says, I'm a 1099 consultant. I've moved closer to my main client. Can I deduct moving expenses? And that's a really good question. As a 1099 contractor, yes, you can deduct moving expenses, but not in the same way you would if you were an employee. When you're an employee capacity and you move 50 miles away from your employer, you're able to deduct your moving expenses on a Form 39-on-3 moving expense form. But as an independent contractor, you are a business owner, and business owners are able to deduct their expenses purely based on the fact that you're in business, and moving is an expense of doing business. So you can certainly take a tax deduction from moving your business. Now, if your business is in your home, you can still take a tax deduction from moving your business in the home. You would want to prorate those costs based on the square footage that you're using in your home, but you're still going to get a tax deduction, and it's going to be above the line, go directly against income. The key is make sure you document your expenses and document them very well. All right, we had another question come in, and this question is talking about, I have an S Corp. I paid an independent contractor his fees for service. He has now given me a W-9 with an EIN number associated with the business, so that when I send him his 1099 miscellaneous form at the end of the year, he's wanting his business name and the business ID number on that form. And the question is, can they do that when all the checks were issued in the individual's name personally? And this is a very, very common issue, where you're paying somebody all throughout the year. Now you're getting ready to issue the year-end documents, the 1099s that are due out to the individuals on January 31st of the following year. And they want you now to issue that 1099 in the name of their business entity with a tax ID number. You cannot do that. The way the checks are paid is the way the 1099 has to be presented. And that's very, very important, because you, the person that's issuing the 1099s, if you issue it incorrectly and you get a 1099 audit that comes directly from the Employment Development Department, the EDD is who audits 1099s, you're going to bear the burden of having to explain that to an auditor, and they're not going to allow your deduction. So you want to do the right thing. You want a 1099, the person you pay the checks to. But here's the key, and this is the way that it should always work. Before you pay anybody as a subcontractor, give them the W-9 form first. The W-9 form asks for their proper identification, who the checks are to be paid to, and it has the proper EIN number. If you do that before you pay the individuals, you will be very, very clear, because sometimes you're going to run into situations where the individuals are not going to want to give you their ID number after you have paid them the checks. So remember, get the ID number first, the check second, and you won't have to worry about that particular issue. All right, we have some more questions. A question is, I'm considering opening a part-time business with a few partners. I have a regular W-2 job as well. Can I offset these expenses against my personal income if the business doesn't happen in the end? So I want to be really, really clear here, because you said you're considering opening up a part-time business. Once you join forces and you start conducting part-time business or full-time business, you in effect have created what's called a partnership. So whether you think you're open for business or not, you are open for business once you start transacting with these other individuals. Although a partnership is not technically a formal type of business, you have in essence created a partnership. Now, here's the key. When you have a partnership and you're in startup mode of a business, IRS will allow you to automatically deduct upfront $10,000 worth of startup costs. Upfront, you can deduct that. But you want to be in business in order to deduct that. So the key is you are in business day one that you and your partners get together and say that you're creating a business. Now, if your expenses go beyond startup costs, let's say you created this business and my expenses are $21,000 for the year. Because starting a business, we know we're going to put out some costs, whether it's phones, materials, service, marketing, our websites, different things. We're going to come out of our pocket. The key to getting all your expenses deducted, regardless of whether you've made a dime, is to make sure that you are able to service your customers, that you are in the pursuit of income. And I want to give you a little analogy. Let's say that we open up a 99-cent store, and inside my 99-cent store, I have my cashier ready to take payments, and maybe I only have half my inventory, but I can still service clients. Now I can do business. But if I'm in a situation where I'm just stocking the shelves and I'm not open to actually do business, then those are all considered startup costs. So the moment that you can serve a customer, it's no longer startup costs, it's normal expenses of doing business. Prior to serving a customer, it's all considered startup costs. Still a write-off, but you get a limitation of $10,000 a year. The key is you want to make sure you're ready to do business with your customers whenever you start transacting and having expenses for that business. That's a very good question. I like that question. Okay, we had another question come in. I was told you can't write off equipment bought on a personal credit card. Is that true? No, that is not true. For the majority of taxpayers, you and the majority of people out there, we're called what's based on cash basis taxpayers. When we pay for something, whether we pay for it by cash, check, or charge, or barter, if we pay for it, it is considered paid. If we pay for that expense, we can deduct that expense. So I never want you to think if I put something on a credit card at the end of the year, or if I'm going to do extended payments on an item, that I can't expense it. You can expense it if it's on a credit card. Remember, it's not how you pay it. It's the fact that it is considered paid to the person that you're receiving the service, equipment, or product from. And so, of course, you can deduct that. Get as much as you can. As we're coming up on the end of the year here, your expenses are going to be very, very important. But if you're listening, one of the keys is always document, document, document. We want to have the credit card receipt. We want to have the receipt for the item you purchased. And then we want to deduct it at the end of the day. So you're going to be in very good shape. Okay. As we move forward, I had another question come in. What is the estimated percentage an employer should budget for payroll taxes in California? And the key is in California, because California, unfortunately, has one of the highest tax states. Payroll expenses are not inexpensive. They can be costly. As an employer, you have to cover half of the person's Social Security and half of the person's Medicare tax. That right there is 7.65%. In California, you also have to cover the unemployment tax. You have to cover the ETT, employer training tax. There's a lot of little things you have to cover. And you also have to cover workers' compensation for employees in the state of California. So I tell my employers to budget at least 20% for the cost of employment taxes. And when you are onboarding an employee, don't just look at how much it's going to cost you in wages. You have to look at the total salary, which includes the employment taxes, which includes the workers' comp, and then figure out, can you afford the total? That's going to be very, very important, because you want to make sure you're able to cover employment taxes. Employment taxes are what's considered trust fund taxes. And if you don't pay those taxes, you will be dealing with a totally different division of the Internal Revenue Service. It's called CID, the Criminal Investigation Division of the Internal Revenue Service. So if you have any questions about that, you certainly want to call us and talk to us about that, because that's very, very important. Another question that's come in is, can I make tax deductions on a rental property for insurance expense and property taxes if I'm not renting out the whole house at full market value? And I love this because this is such a common place and space for a lot of people. A lot of people have people they're renting rooms to. People are now cohabitating, staying together for the share of expenses. If you are the homeowner and you're renting out a portion of your home, you want to be able to take that portion of your home as a rental and take advantage of all the costs associated with having that rental. For example, if you're paying homeowners insurance, that's a cost. If you're paying utilities, that's a cost. Property taxes, that's a cost. If you have a mortgage, that's a cost. The way you want to allocate those expenses are going to be based on a couple of different ways. But let's say, for example, if I have roommates and we have a 3-bedroom home, and let's say that I have 2 of my bedrooms rented out and everybody gets to use the common area space of the home, then 2/3 of the expenses should be allocated to the rental portion of your home. If you don't have it where they can use a portion of the whole house, where they can have common to all, then you have to allocate based on square footage, just the utilization of the room, maybe a hallway, bathroom, something of that nature. But the key is to have a reasonable basis on the way you allocate those expenses, and certainly take those expenses against other income, the rent income and other income on your tax return, because that can give you a great tax deduction plus depreciation expense. If you have any questions and want to talk to myself or my guests, please reach us at 800-721-7374. That's 800-721-7374, or reach us at nybuniversity.com. That's nybuniversity.com. Thank you so much for listening. I can't wait to have this conversation with you again next week. And remember, mind your business.